Welcome back. Recently, there was a publication of bank earnings, and as you know, the banking sector one of the most competitive in the world. And for the unacquainted, we might as well invite you to this interesting discussion as we look at the driving objective of every bank, which is to make profit, and what has characterized most media outlets with banks sharing their profits through balance sheets. To look at this is a financial and investment analyst, Munyumba Mutwale, to break it down for us. Thank you for coming.
Thank you very much, Randy.
Right. So let's start with the recently published bank earnings. And for those that might have missed them, what are they talking about?
So the main thing is that we've seen another year of record profits for banks. Banks in Zambia closed over about 5 billion kwacha when it comes to collective profits, adding 7 billion kwacha actually of collective profits, and they've actually been able to grow their profit books by about 10%. So we've actually seen that even in an economy that was relatively sluggish but did pick up towards the end of 2022, we've seen the banking sector being characterized as one of the faster growing sectors. Now, the main conversation points of these bank earnings has been the battle of the two. The top two being Zanaco and Absa, who basically make up almost half of bank earnings and have done so, bank profits, in the last year. You saw that both of them had registered, while one registered 4 billion kwacha in revenue and the other one registered about 3, you saw that they both were head to head in what we call profit before tax, 1.9 billion and also just a bit lower at 1.94. But edging out, number one was Zanaco with 1.35, 28% higher profits than last year, while Absa was then number two, followed by Stanbic. So you're seeing banks not only coming in with high profits, you're seeing the top banks coming in with record levels of profit.
Right.
Yeah.
Many might find that very hard to understand because of the narrative that this country is going through. Yeah. Challenging at times, economically. What activity is leading to this? Where are the banks leveraging, their profits on?
So you do see that there is growth in interest income. That is the first point. Now, everyone's number one concern is if access to credit is such a big problem, then how are banks being so profitable? So one of the biggest customers of banks historically has always been the government, especially over the last couple of years. I mean, the government really crowded out a lot of the SME sector during this period. But astronomically, I think one of the funny things about this year was that we actually saw the crowding effect less. Government went from, in 2020, 33% of all new loan disbursements down to only 8% of all new loan disbursements in the banking sector, at least in the first 2 quarters of 2022. Which means that the banks are actually making money lending to businesses as opposed to lending to the government. And I'm talking about commercial loans, not retail to individual loans. So one of the things also which did characterize this year is the growth of SME loans. SME loans used to be only 11% of new loan disbursements, but now they've gone up to over 25% of new loan disbursements according to the credit survey. So that means that in general, banks are actually making money lending to people again, and they're lending to the parts of the economy. And that's probably why we've seen some of the interest rates, especially commercial rates, starting to slowly come down. Now, is that going to happen overnight? No. It's going to take a bit of time because they've got deposits that they have to manage. And also the lending rates to government are still elevated. And remember that government is considered the risk-free lender. So they're the basis before we start adding risk premiums for individual investors. So at the beginning, we can see at least that the market is starting to disperse to the productive sectors of the economy. And it's good to see that they've made record profits. Now, the biggest concern obviously is going to be that if bank profits always outgrow salaries, and they outgrow small businesses, you're often breeding inequality. And unfortunately, the administration currently is battling that image of not attending to inequality enough.
Right. So on one hand, you hear stakeholders, investors, and various entities complain about interest rates, that they could be friendlier.
Yeah.
On the other hand, are we saying that they really don't mind?
No, I mean, interest rates are really high in this country. This is unsustainable. But the first thing we have to do as a country to get our interest rates down is to reprofile our debt. This is why it's extremely important. I think people don't understand how big this thing plays out. So let me play it for you mathematically. an outside investor is actually the one who determines the interest rates of your country. So effectively, you have to first look at what is the interest rate being set by the American Central Bank. That's the first baseline you have to look at. Currently, they're now at about 4% heading towards 5%. And you do find something called London Interbank Rate, which is the lending rate overnight between the London banks, which is what reflects into Zambia. Into emerging and developing countries, that's what affects. So that's the baseline. Then we are a country deemed as in default. So remember, we're in default with our debt. And what that does is it downgrades our credit standing around the world. So for a foreign investor to invest in any instrument in Zambia, they first want the 5% that they get from LIBOR, then they want 20.71% in US dollars for what they want to get in Zambia. So you've got about a 26% point here that just is the baseline that they're even willing to invest in Zambia. That 20.71 is called the country default, is called the country risk premium.
Right.
So that's the premium for an offshore investor to come into Zambia and then invest or at least buy up any instrument. So that's already affecting your lending rates with your government bonds. Now, government bonds are basically seen in Zambia domestically to a bank that's risk-free. Because you know that on your note of paper, it says, I promise to pay the lender. That's the government. And you know that a government bond is also a promise by the government.
Right.
So a government bond is considered as cash. It's the same as cash. So it's got almost zero risk towards these banks. So anyone who comes and asks for a loan has to first beat what the government is giving the bank, and then that's what we call a risk premium. So how do we bring this down? Bring the country risk premium down by reprofiling your debt. Once you renegotiate that debt, Zambia's government debt rates start to come down, and that starts to bring down the rates that are actually in the economy. So until that goes away, interest rates are always going to stay high. That's why you need a government that's prudent. You actually need them to manage their money properly because they transmit interest rates to others. One, because we don't issue out sovereign debt mainly in our own currency. We're not one of the major currencies. America can issue piles of debt because that's in their currency. The majority of their debt sits in their currency and they have total control of it. We don't have that same situation. So it affects even the domestic debt. So if you want the average person to start getting those old single digit or 12% rates that we all got accustomed to, that we would like to see back, you need a government that can borrow at much less than that. And therefore you need that risk premium down.
Right. So for those that are not in the top 5, what happens? They continue just surviving?
Well, unfortunately, the other banks did fine. Let me tell you, as a sector,
right,
the banking sector, if you're looking at profit margins, and I think this is where it gets a little bit concerning, is the size of the profit margins that we're seeing in the banking sector. I think number one, in terms of profit after tax, profit attributable to shareholders, Zanaco was number one. But in terms of profit margins, in other words, percentage of revenue that is profit, 45% of ABSA's revenue went into profit. And I'm talking profit after tax.
Right.
And then you're seeing the same thing. You're seeing the same thing with the number 2. The next one was FNB, then you saw Stanbic. They were all in the 30s. The lowest out of the top 5 was actually Zanaco itself, meaning that they were actually taking more risk. In other words, they were lending more. So you often find that banks, characteristically, banks who have higher profit margins often are banks who take less risk and they lend less to the smaller parts of the economy because small businesses, individuals are deemed what they call as risky. Mm-hmm. So you'll see that the banks who have thinner profit margins are often the ones who extend credit more to the lower parts of the economy where you find more defaults, more need for management, more credit screening. So my big concern out of these is the banks that have got huge profit margins. That often signals to me that maybe they're not extending enough credit to the bottom parts of the economy as the ones who've got lower profit margins who are trying to do so. So yes, we'd like our banks to actually do well because it's a signal of how good our economy is doing. But you really want to make sure that it's not at the expense of economic inclusion, especially of the small business that needs to grow. My biggest problem, I think, Franklin, what came down to when we did that 10 billion kwacha facility. My firm did a study on it, and we found that when we looked at the bank clients who made up the top 10% of customers, or the top 20% of customers, we found that they got over 75% of the money.
Or the 10?
Yeah, the top of the 10 billion,
right,
about 20%, the top 20% got 75% of it, and then the remaining 80% were left to scrounge for the remainder. When that instrument was issued to help people through the COVID download, the lockdowns. Now, the businesses that need that. You see, a big business, if you're a big multinational business, you've got reserves and you've got access to go to a bank without that facility. A small business has 21 days of cash.
But everybody
maximum.
went in.
But that's the problem. So unfortunately, most of the money gets to the top. At the beginning, it was actually even worse. 1% of the group were getting 80% of the money. In fact, it even got better over time. So by the end, they started to unwind it. But when half of the instrument was issued, 1% were getting about 90% of the money. And that was a big problem. That's where inequality comes from.
So the misfortune for the ones that you consider are in the the lower bracket is that if they also become too cautious, they might not survive. They have to take the risk.
Yeah.
They have to continue lending.
What you need is banks to have no option but to lend to me and you. And this is why we have capital markets in this country. You want the bigger parts of your economy borrowing from capital markets, issuing corporate bonds, so that they don't go directly into a bank to try and get money. You want them issuing equity. You want them floating shares on the stock market so that they look for capital in alternative ways. So that the main job of a bank is to lend to the individual who needs to build a house, to the shopkeeper who wants to buy a second store, to the transporter who wants to buy a second car to expand their businesses, to the radio owner who wants to put up a tower, because that leads to 10, 20 jobs. Remember that over 70% of your jobs in this country come from what? Small businesses.
Right.
So, and especially young people. The young people of this country have been crying about unemployment. You need to make sure that the small businesses have got low tax regimes. You need to make sure that the small businesses have got access to capital so that when they expand, the beauty about small businesses is they're labor intensive. So they always tend to hire, and because they're not big, expensive businesses, they hire inexperienced people, meaning young kids coming out of college get their first job in small businesses, and then they get their experience, which allows them to not be unemployed. So the capital system of this country, being the bank lending system, has to be engineered in a way that supports that. Now, the first step was done. If you look at it from a broad perspective,
right,
government going from 33% of new issues loans down to 8% gave space to the banks to now start lending to the smaller parts of the economy. And that is the improvement at least we can get.
So as a final thought, it appears to me that there'll have to be a cultural shift, especially among the smaller businesses or people that want to borrow. This issue of defaulting, the high default rate, it obviously starts from an individual level. I don't think that a lot of us love to pay back, but that to encourage the big banks to think, they can also lower, to that level. Maybe the conversation should start from this attitude of not wanting to pay back.
It's a chicken and egg situation,
right?
Because you don't want to pay back, but it's also very hard to pay back a 30-40%.
Okay, that's quite high, yes.
So it's very difficult to pay out these loans. So how do you get small businesses to, first understand their systems? I think too many people rush for capital too quickly in this country.
Okay.
We've created a culture of you start a business and the first thing you're looking for is capital before you're looking for customers. So, and banks primarily lend money based on cash flow. Do you have active cash flow to be able to pay back that? Then you offer collateral to securitize that, to secure it for them. So remember, the first thing is your cash flow. So to get these banks to be comfortable lending, businesses also have to get into the ability of generating cash flow with the little means they have, getting from that journey from 0 to 100,000 in sales regularly, and then you can start going to banks. The second thing I would urge as many small businesses to start doing is most of them don't have the adequate collateral for bank loans. If you want to improve, this is what I advise most small businesses or most entrepreneurs, take a portion of your sales, buy up government securities. I'll tell you why. Government securities or government instruments of debt, whether it's treasury bills or bonds, are actually the perfect collateral to a bank. They don't, better than your land, better than your car, they don't even discount it.
Okay.
So if you want small businesses to access more capital, get them to start building better reserves in treasury bills and bonds, that might actually help them go into a bank and say, use my treasury bills and bonds as the collateral, then I can access your loans much better. They'll find a much more friendly environment.
Well, let's hope that happens sooner than later, and I hope somebody is listening out there. Thank you for coming.
Thank you very much.
A pleasure. Munyomba Mutwale, an investment and financial analyst, breaking it down for us with regards the report that was recently published looking at bank earnings. Let's take a short break.